Hello, welcome to chapter 12. Today we're going to talk about the cash flow statement. In this topic, here are the learning objectives. Okay, by the end of the topic, you should be able to explain the need to report for cash. You should know how to prepare a statement of receipts and payments. Explain the role of cash journals in reporting for cash. So by cash journals, I'm referring to the cash receipts journal and cash payments journal. You need to be able to define terms such as what is a cash surplus, what is a cash deficit. Define what are operating, investing, and financing cash flows. You need to know how to prepare a cash flow statement. And you need to be able to explain what's the use for cash flow statement, what are the purposes for preparing a cash flow statement. And importantly, you need to explain the difference between cash and profit, okay? As we've touched on in chapter 10, when we talk about balance day adjustment, we know that cash and profit are different things. Cash-based accounting and accrual-based accountings refer to different concepts, okay? So you need to be able to explain what's the difference between cash and profit and identify reasons why a firm's cash and profit performance may differ. Okay, so why do we need to report for cash? So far we have considered how to report for profit and loss, okay? Since generating a profit is the primary reason for being in business, okay? Business owners, they must have accurate information about revenues, expenses, net profit or loss when they analyze the firm's performance. However, in reality, a lot of profitable businesses do fail if they do not have sufficient cash or they are unable to manage their cash effectively. So that's when we call the business encounters liquidity problems, all right? So this is why we need to have detailed information about the cash. All right, a common misconception is that profit and cash are the same thing, okay? Some think that if they sell their products at a profit, then they will automatically have cash available to pay off debts. Unfortunately, this is not the case. Cash and profit are separate measures of performance. Okay, very, very important. You need to remember that cash and profit, okay, they're different. Okay. There are many reasons that why a firm that is earning a profit can still suffer from a cash shortage, and we'll talk about the reasons why cash and profit may be different later on. All right, so I want you to think about this for the moment. Question for you, how can this be? How can a business that is earning a profit suffer from a lack of cash to pay its bills? Or on the other hand, conversely, how can a firm that is generating a loss still boast a healthy bank balance? Okay, so the change in a firm's bank balance is calculated by comparing cash inflows and cash outflows in a given period. Okay, whereas profit is calculated by comparing revenues earned and expenses incurred in a given period. And cash and profit items, they may differ because of the following three scenarios. Okay, firstly, some cash items do not affect profit. Secondly, some profit items do not affect cash. And thirdly, some items affect both cash and profit, but by differing amounts. All right, let's have a look at the first scenario. Cash items that do not affect profit. All right, so some cash inflows, they are not considered to be revenues. For example, capital contributions by the owner and the loans received from external finances or banks. They are cash inflows that will increase your cash at bank, but they are not revenues, so they will have no effect on profit. These items can explain why a firm has been able to keep a healthy bank balance, even though it may be generating a net loss. Similarly, some cash outflows are not expenses. For example, cash drawings, okay? Cash drawings by the owner, or loan repayments, or cash outflows for purchasing non-current assets. They are all payments that will decrease cash at bank, but they are not expenses, so they will not affect profit. And this will explain why, a firm may suffer a decrease in cash, yet still earning a profit. Okay, so this is a summary table, okay, that shows you a summary table for cash items that do not affect profit. Okay, so on the left hand side we have cash inflows that are not revenue. So we talk about this capital contribution, loans received, or GST received, including GST refund. So all these items, they are cash inflows. They will increase your cash at bank, but they are not revenues, so they will not affect profit. Okay, on the right hand side, cash outflows that are not expenses. Okay, you can have cash drawings, loan repayments, cash payments for non-current assets if you want to purchase using cash to purchase non-current asset, or GST paid, including GST settlement. All of these are cash outflows, but they are not expense items, so they will have no effect on profit. Okay, let's have a look at the second scenario. Okay, profit items that do not affect cash. Some revenues, they are not cash inflows. For example, stock gain. Okay, stock gain is a revenue that will increase profit, but because it's a gain of stock, not cash, so it will not affect your cash. Similarly, some expenses are not cash outflows. For example, we talked about in chapter 11, depreciation. Okay, it's a non-cash expense. And depreciation, other examples, bad debts or stock loss, they are all expenses. However, they do not involve any cash outflows. All right, so this is a summary table, okay, for profit items that do not affect cash. So on the left-hand side, you will have revenues that are not cash inflows, stock gain. Okay, it's a gain of stock rather than cash. On the right-hand side, expenses that are not cash outflows. So stock loss, okay, non-cash expense, bad debts, non-cash expense, depreciation, again, non-cash expense. They are all expenses, but do not involve any cash outflows. Okay, items that affect both profit and cash, but by different amounts. So this is the third scenario, the final scenario we can talk about, why cash might be different to profit. Okay. First one we're going to have a look at is credit sales versus receipts from debtors. Okay, so if you sell goods on credit, this will immediately increase your profit. Okay, but may not involve any cash flow until much later, until when the debtors decides to pay you. So the different amounts reported as credit sales and the receipts from debtors referring to the cash receipts from debtors, okay? The difference between these two could explain why profit and cash are not the same. Okay, there's often a timing difference, okay, between the two. Timing difference between when you've sold goods on credit, okay, which will immediately increase your profit, and there's going to be a time lag until when you receive the payments from debtors. Okay, next case, cost of sales versus payments for stock. Okay, cost of sales represents the value of stock sold, and this may not be the same as the amount that has been paid for the stock. Okay, so if cost of sales is greater than payments for stock, it will reduce profit more than it reduces cash. All right, what this means is if you've purchased the stock for cash, okay, you've made some payments for stock. However, in this period, if you've sold more, okay, in terms of cost of sales, then it will reduce profit more than it reduces cash. Okay, think about the opposite scenario. If cost of sales is less than payments for stock, then it will reduce cash more than it reduces profit. Okay, so in a particular month, in the current month, let's say you've made some cash payments for stock. Okay, however, the actual sales you've made is not so good, and so the cost of sales is less than the payments for stock. So in this case, the cost of sales, this expense item, is going to reduce your profit. Okay, less than how much the payments for stock reduces your cash balance. Okay. Now, the next one, balance day adjustments. Okay, because of balance day adjustment, the amount paid for expenses is often different to the amount incurred. Okay, we've covered this in chapter 10 when we talk about balance day adjustments. So, for prepaid expenses, the amount paid will be greater than the amount incurred in the current reporting period, because you are paying, by definition, prepaid expenses. You are paying the dollar amount in advance. However, you have not yet incurred or consumed all of the expenses yet, so the amount paid will be greater than the amount incurred in the current reporting period. Okay. Which means cash decreases more than profit. Okay, however, for accrual expenses, okay, do you remember what accrual expenses mean? That's when you have incurred or you have consumed the benefit. Okay, you've incurred expenses but have not yet made a payment. So the amount incurred will be greater than the amount paid. So this means, which means profit decreases more than cash. All right, so because of all these reasons, okay, in practice usually it's a variety of reasons or combination reasons, so why profit and cash may differ. So, a combination of all the reasons we have talked about that may cause your cash at bank, okay, to be different to your profit. Okay, two separate, distinct concepts. All right, so let's have a look at the scenario that a firm may earn a net profit but suffer a decrease in cash because of the following reasons. And for each reason we're going to talk about, we're also going to talk about an example, corresponding example. So, cash outflows. First reason, cash outflows that decreases cash but are not expenses and so do not affect profit. For example, these are the examples, all the examples we can talk about, your cash drawings, loan repayments, cash payments for non-current assets. You've used cash to purchase a non-current asset, or overall more GST paid than received, okay, including GST settlement. So all these cash outflows, they will decrease your cash, okay, but they will not affect your profit because they're not expenses. All right, other reasons. Now, next one. Revenues that increase profit but are not cash flows and so do not affect cash. Okay, for example, stock gain. Stock gain will increase, will increase your net profit. So the firm may earn net profit. That will have a positive impact on your net profit. All right, but it will not affect your cash. All right, next line. Revenue items that increase profit more than the corresponding cash inflow increases cash. Okay, so in this case, the example I want to give is credit sales may be greater than the actual cash receipts from debtors. So this will increase profit more than the corresponding cash flow increases cash. Finally, expense items that decrease profit less than corresponding cash outflow decrease cash. So cost of sales less than, if the cost of sales is less than the payments for stock, Okay, so in this case, the expense item will decrease profit, but less than how much it decreases the cash. Okay, or you can have other balance sheet adjustments such as other expenses incurred, okay, less than actual amount paid, which means that again it will decrease profit less than it will decrease the cash. So just to quickly sum up, these are the reasons and their corresponding examples that explain why a firm may actually earn net profit but suffer a decrease in cash. Okay, let's consider the opposite scenario. So on the other hand, okay, a firm may incur a net loss but generate an increase in cash. How? Okay, because of these reasons, and these are the examples. So first reason, cash inflow, that increase cash but are not revenues and so do not affect profit. So things like capital contributions, loans received from bank or other lending institutions, overall more GST received than paid, including GST refund. All of these cash inflows that they will increase the cash but will not affect your profit because they are not revenues. Okay, so next one, expenses that decrease profit but are not cash outflows and so do not affect cash. Okay, these are the expenses, may incur stock loss, bad debts, depreciation. All these non-cash expenses will cause your profit to decrease or even lead to the firm generating a net loss, okay, but will have no effect on cash because they are non-cash expenses. Revenue items that increase profit less than the corresponding cash inflow increase cash. So again, the example opposite to what we've considered before, if you have credit sales less than receipts from debtors, it means that this will increase your profit to less than how much it increases your bank balance. Okay, expense items that decrease profit more than the corresponding cash outflow decreases cash. Okay, the example here is when your cost of sales is greater than the payments for stock. Okay, remember cost of sales is an expense. Okay, so that means it will decrease your profit more than it actually decreases your cash balance. Or in the case of balance sheet adjustment, if other expenses incurred is greater than paid, it means that it will decrease your profit more than your bank balance. Alright, so that's all for the first part. Okay, the video continues in the second part.